Welcome to the Deep Dive, your shortcut to truly understanding what matters in the world of finance and risk. If you're an insurance risk manager, well, you know the feeling. That constant hum of regulatory updates, especially for something as huge as Solvency 𝗬𝗧. I mean, it's a colossal framework, governs trillions in assets, and just keeping pace can feel like a full-time job. So, our mission today. Cut through that complexity, we're doing a deep dive into the latest review of the EU's Solvency 𝗬𝗧 framework. Specifically, we're looking at the proposed amendments in Directive EU 2022. That's the one refining Delegated Regulation 2535. Now, for you, a risk manager, this isn't just ticking compliance boxes. It's about grasping the shifts in operational risk, capital requirements, really how these changes reshape your whole strategic landscape. We want to help you get genuinely well-informed, find those aha moments without drowning in jargon. So let's unpack this latest draft from the European Commission.
Exactly. And what's really interesting, I think, isn't just what the changes are, but the thinking behind them, the why. This deep dive will explore how these amendments aim to, yes, protect policyholders and maintain financial stability, that's core, but also, and this is critical, how they're trying to unlock the insurance sector's huge potential to, well, fuel the real economy, especially things like sustainable investment.
Okay, let's start right there then, with that why.
Yeah.
Solvency II, when it arrived, it was revolutionary, right? Modernizing supervision, risk-based capital. But now it's getting this significant overhaul. So what specific problems are these amendments really trying to solve for you, the risk manager, and for the whole sector? And why the big push now?
Well, fundamentally, a major goal is boosting competitiveness and, crucially, real economy investment. The Commission's been quite explicit. They want to make it easier for insurers to provide long-term capital financing for businesses. Think SMEs, venture capital, private equity, infrastructure. It's pretty telling that right now securitization makes up less than 1% of insurers' investment portfolios. They clearly see room for growth there.
Right, less than 1%. That's low.
Very low. And the review seems designed to address that kind of thing.
And there's this idea that the review itself will free up capital. Capital that's currently tied up by the existing rules.
That's a key expectation, yes. Capital in excess of the solvency capital requirements. And it's not just hoping it gets used well, they're explicitly encouraging it to be channeled into productive investments. Supervisory authorities are even being asked to, monitor how that capital gets deployed.
So it's a deliberate nudge, maybe even a push towards reallocation.
Absolutely. And it comes directly from evaluations that flagged 5 main shortcomings in the current framework. First, they found it created disincentives for long-term equity investing and didn't adequately capture sustainability risks. That's a big one now. Second, it wasn't great at handling long periods of low interest rates, leading to, as they put it, unduly high volatility in solvency positions. Third, just too complex for smaller, less risky insurers. You hear about unjustified compliance and reporting costs. Fourth, some cross-border failures showed gaps in supervision. And finally, maybe not enough tools to stop systemic risks spreading.
Okay, this is where it gets really interesting, I think. It's not just tweaking rules around the edges.
Right.
It feels more like a fundamental realignment, trying to make the framework fit today's economy and, well, strategic priorities like the green transition. I mean, imagine the impact if more of that, 10 trillion euro under management could actually flow into productive long-term stuff. That's a huge potential lever.
It is, and it brings up that classic balancing act, doesn't it? How do you maintain a robust prudential oversight you have to protect policyholders while also allowing flexibility and, frankly, competitiveness? The review seems to acknowledge that Solvency II, while sound overall, had these pockets, these undue prudential disincentives, particularly for things like long-term capital.
Okay, so let's dive into those nuts and bolts then. The capital requirements. This must be where you, the risk manager, are going to see some really direct impacts day to day. What's changing?
A really direct one is in technical provisions and the risk margin. The old risk margin calculation was often seen as, well, overly conservative, especially for very long-term liabilities. Now they're bringing in an exponential term-dependent factor. Sounds technical, I know, but the idea is simple. For liabilities stretching way out, decades even, the risk doesn't just keep piling up linearly. This factor recognizes that it kind of tapers off.
Okay. So it's meant to be more realistic for long durations.
Yeah, exactly. To correct the conservative bias, as they say, and reduce technical provisions, the bottom line, it should increase the capital available. They're talking specific numbers. An annual reduction of risks of at least 3.5%, though capped at 50%. And the cost of capital rate used in that calculation is set at 4.75%.
So for insurers with long-term business, that could mean a tangible release of capital that was maybe unnecessarily trapped before.
Precisely. That's the goal.
And are there also tweaks to how the liabilities themselves, the best estimates, are valued? Especially for complex policies.
Yes, some important refinements to best estimate valuations. There's more clarity now on offsetting losses from one group of policies against profits from another group, not just within similar risk groups, but actually between different groups.
Oh, interesting. That sounds more holistic.
It allows for a more realistic overall picture, yeah.
Yeah.
And particularly helpful for smaller, non-complex firms. There's an allowance for prudent deterministic valuation for options and guarantees that aren't material. Should simplify things quite a bit for them.
Okay. Now, what about interest rate risk? We've had years of low, even negative rates, market swings. How's the framework adapting there?
Yeah, that's a big one. Under interest rate risk and volatility adjustment, the rules are finally catching up with reality. They now explicitly state that interest rates can become negative or decrease further when they are already negative. They even reference the period between 2016 and 2019 when this actually happened.
So no more pretending rates can't go below zero in the models.
Right. And to stop things getting too extreme on the downside, they've brought in a maturity-dependent floor. For example, it's 1.25% for maturities between 1 and 7 years. Prevents assumptions becoming, well, completely untethered.
That sounds huge for managing market risk. Being able to properly account for negative rates, plus fine-tuning the volatility adjustment, it means a much more accurate reflection of your real exposure, right? And potentially less capital pressure during market stress or those long low-rate periods. Addresses one of those core problems you mentioned.
Absolutely. And the volatility adjustment enhancement builds on that. The risk correction formula is being tweaked. Essentially, the bit of the spread assumed to cover expected losses will now decrease as overall spreads widen. There are caps to 65% for government bonds, 125% for others, like corporate bonds, loans, securitization, and maybe even more impactful for some models. They're lowering the assumed correlation between spread risk and interest rate risk when rates fall, down to 25%.
25%, that's a specific number.
It is. And if you link this back to the big picture, these aren't just random tweaks. They signal a real move towards more granular, more reality-based risk sensitivity. Those numbers, the 3.5% risk margin reduction, this 25% correlation factor, they give you concrete parameters for your models. Should make them better reflect what's actually happening in the market.
So we've got freeing up capital, more realistic valuations. But what about actually encouraging that capital into the real economy stuff we talked about? Which brings us neatly to equity investments. The outline mentioned preferential treatment for long-term equity. How does that work? How do you qualify?
Good question. For this long-term equity preferential treatment, the insurer has to basically prove something. They need to demonstrate that they are able to avoid forced sales of equity investments for a period of 5 years.
Avoid forced sales for 5 years. Okay, how do you demonstrate that?
It's not just ticking a box. You can use detailed internal methods, or there's a more concrete option, a forced selling test. This involves projecting your cash inflows and outflows over 5 years, but under stress conditions. If you can show you wouldn't be forced to sell those equities even under stress, you can qualify for better capital treatment.
I see. So it directly incentivizes holding for the long term by linking it to liquidity resilience.
That's the idea. Makes holding those strategic long-term stakes more capital efficient if you can prove you can weather the storm.
And I think I saw something about public support, aligning with banking rules for certain investments.
You did. For publicly supported equities, there's a new specific prudential treatment. This applies if an equity investment is part of a legislative program that gets significant subsidies or guarantees from public authorities. It basically copies a rule from the banking sector Article 133 of the Capital Requirements Regulation, Regulation 575-2013. It could apply up to 10% of your eligible own funds.
Okay, so that's a clear signal, trying to align incentives, leverage public money to de-risk certain strategic investment.
Exactly, using the regulatory framework to support broader policy goals.
How about the symmetric adjustment mechanism? Is that changing?
Yes, the limits are being widened quite a bit. It can now range not lower than net 13% or higher than 13%.
Minus 13 to plus 13, so wider than before.
Wider, yeah. The idea is to give it more power to dampen those pro-cyclical effects. When markets swing wildly, this adjustment can lean against the wind more effectively. It provides more of a buffer, a better shock absorber.
Got it. Okay, next up, securitization positions. Historically often seen as complex and attracting high capital charges for insurers. What's the shift here?
Well, remember that goal of boosting real economy investment and facilitating bank lending? This is part of it. They want to make it easier to transfer risk outside the banking sector. So the risk factors for securitization investments are generally being reduced. There are new specific risk factors for non-STS senior tranches that's non-simple, transparent, and standardized. And for the STS senior tranches, the good quality stuff, the risk factors are now aligned with covered bonds.
Aligning with covered bonds.
Yeah.
That's quite a reduction, isn't it?
It is. It makes holding high-quality securitization significantly more attractive from a capital perspective, trying to make it a more viable asset class for insurers.
Okay. And counterparty default risk. Are we finally seeing mortgage loans treated, well, realistically, rather than assuming they're almost risk-free?
We are. A new floor to the loss given default is coming in for mortgage loans. 5% times the loan amount. This directly corrects that old standard formula assumption where they were, as you said, unduly assumed to be risk-free. That was a frequent criticism.
About time, some might say.
Indeed. Also, related to counterparties, the capital requirements for direct exposures to CCP's central counterparties are being lowered. They're being aligned with indirect exposures. The aim is to remove any disincentive for insurers to become direct clearing members, which is generally seen as safer for the system.
Right, encouraging central clearing.
And one more tweak here. Repo transactions and securities lending are being reclassified as Type 1 exposures. Generally means less conservative capital treatment.
Okay, wrapping up the capital requirements section. Reinsurance and risk mitigation. Anything new on how insurers get capital relief for transferring risk, especially for those unexpected claim surges?
Yes, a couple of important points. First, adverse development covers. These are non-proportional reinsurance deals designed to protect against nasty surprises in how claims develop over time. They're now going to be explicitly recognized in the standard formula. That's a win because it better reflects the real risk mitigation they provide.
So, proper credit for that type of reinsurance.
Correct. Second, national schemes that serve as reinsurers of last resort, provided they're backed by a member state, are now recognized as having a similar risk mitigating effect to private reinsurance. Provides a bit more certainty around those government backstops.
Oh, interesting.
But the key principle, always, is that any capital reduction you claim from risk mitigation has to be commensurate with the actual change in risks. No free lunch, it has to be genuine risk transfer.
Right, makes sense. Okay, let's shift gears slightly. Beyond the pure capital calculations, these amendments seem to really tackle how you, the risk manager, handle compliance and operational risk day to day. There seems to be a very strong push for proportionality. You mentioned earlier the previous framework's implementation was seen as insufficient, and that was a key driver here.
That's absolutely right. There's a very deliberate move towards enhanced proportionality. For many firms, this should hopefully mean less administrative headache. We're seeing simplifications to parts of the standard formula that were considered unjustifiably burdensome or costly. For instance, there's now a specific carve-out from the mandatory application of the look-through approach for investment funds under certain conditions. Exceptions for using external ratings are also expanded.
Look-through can be a real pain, so a carve-out is welcome news for many, I bet.
It can be, yes. Even the man-made catastrophe risk submodule is simplified. Little things that add up.
And it sounds like it's not just allowing simplification, but making it clearer when you can actually use it. More predictability.
Exactly. The new rules set out clear, exhaustive conditions for when supervisors can approve proportionality measures. Think things like reporting less frequently, maybe a lighter touch review of internal policies, streamlined ORSA processes, the own risk and solvency assessment, maybe even combining certain key functions.
So a clear path for firms to argue for and hopefully get approval for applying proportionality. That should reduce those unjustified compliance costs.
That's the intention, and it goes further for the smallest players.
Ah, yes, you mentioned a new category.
Yes, a brand new category. Small and non-complex undertakings. These firms will automatically benefit from a predefined set of proportionality measures. Covers reporting, disclosure, governance, how they calculate technical provisions. The ORSA, it's quite broad, should make a big difference for them.
And on a practical note, inflation adjustments.
Right. Almost forgot. All the fixed euro amounts throughout the regulations thresholds for applying rules, capital levels, potential fines, are being updated to reflect inflation. They note that cumulative inflation since Solvency II started is nearing 35%, so these adjustments are needed to keep the thresholds meaningful in today's terms.
Good point. Okay, let's talk about system of governance improvements. I saw one requirement that really jumped out, very relevant today, climate change risk. That feels like a major signal, doesn't it?
Oh, absolutely crucial. It's a new explicit requirement. Insurance and reinsurance undertakings shall put in place internal procedures to avoid over-reliance on data from past events with respect to climate change-related trends.
Avoid over-reliance on past data.
Exactly. Including, where appropriate, by using climate scenarios. This is a clear push towards forward-looking risk assessment becoming embedded in governance. You need to be thinking about and using climate scenarios.
So no longer just optional best practice, but a core governance requirement.
Seems so. Alongside that, there's more clarity on the internal audit function's tasks, needing an audit plan, using a risk-based approach, making recommendations. And remuneration rules are being aligned more closely with banking standards. Things like malice or clawback arrangements and deferring variable pay are coming in, although with proportionality for smaller amounts.
Malice and clawback, bringing insurance comp closer to banks.
Yes. And finally, just clarifying the conditions under which supervisors can impose capital add-ons related to the volatility adjustment or transitional measures. More transparency there.
This all feels like a big win for operational efficiency, particularly the proportionality bits and the clearer reporting. And that explicit climate scenario requirement is definitely a sign of the times.
It really underlines that shift away from a rigid one-size-fits-all approach towards something much more risk proportionate. For you, the risk manager, hopefully it means less time on burdensome admin in some areas, freeing you up to focus on the really critical risks, including these emerging ones like climate.
And speaking of reporting, what about the big public report, the SFCR, the Solvency and Financial Condition Report? Any changes there?
Yes, a significant redesign under reporting and disclosure streamlining. The SFCR will now be clearly split into two parts.
Two parts. Okay, why?
To cater to different audiences. One part is specifically aimed at policyholders and beneficiaries. It needs to be concise, accessible, simple, and get this, not exceed 5 pages.
5 pages, that's concise.
Very. The other part is for market professionals. That's where all the detailed technical information will live. It just acknowledges that policyholders and analysts need very different things from that report. Should make it much more useful for everyone.
That makes a ton of sense. More user-friendly. What about the report supervisors get, the RSR, Regular Supervisory Report?
That's being streamlined too. The content should be reduced to avoid duplication with the ORSA report. The focus will be only on what's truly necessary for prudential supervision. Less overlap, less redundancy.
Good. Less duplication is always good.
Agreed. Plus, new requirements for making disclosures available online and keeping them accessible for at least 5 years, enhancing transparency again. And finally, just some clarifications around group solvency calculation. Things like eligibility of group-owned funds, how to treat related companies, and simpler approaches for related undertakings that are immaterial, just aiming for more consistency and practicality at the group level.
Okay, so let's try and wrap this up. For you, the risk manager listening, the big picture seems to be these proposed Solvency II changes are driving towards more accurate, maybe less conservative, risk measurement in capital. That promises potentially greater capital efficiency, clearer rules for long-term investing, and importantly, a real push for proportionality and streamlining in compliance and reporting, especially if you're a smaller firm.
That sums it up well. The goal seems to be a framework that's still resilient, absolutely, but also more agile, more sensitive to risk, and better aligned with today's economic environment and priorities. Fit for purpose, you might say.
So as you digest all this, think about how these specific changes might impact your current risk models, your capital management strategies, your reporting workflows, because these amendments, they aren't just about regulatory tweaks. The stated aim is to unlock capital, steer it towards productive investment, think green transition infrastructure. So for you, the risk manager, the challenge isn't merely compliance. It's also about how your function, your insights, can proactively contribute to these bigger economic goals. What new opportunities might this updated landscape create? How will you potentially leverage this enhanced flexibility if it materializes as planned to support strategic growth for your company, while always maintaining that core prudential soundness and protecting policyholders? That's the provocative thought to leave you with.